This is Super Investors and the Art of Worldly Wisdom. I'm Jesse Felder.
Object to the test!
As always, this episode is brought to you by the Felder Report. Each week I go through a ton of reading and research. I put together the 5 things that I found most valuable during the week into a Saturday morning email. If that's something you'd be interested in receiving, just go to thefelderreport.com. Right there on the homepage, click Join Now, and you'll be good to go. My guest for this episode is Bill Fleckenstein. It's hard to believe that it's been almost 3 years since I started this podcast and made the trek up to Seattle to interview Bill as one of my first guests on the topics of central bankers, financial bubbles, and white burgundy. And if you haven't listened to that one, I encourage you to do so because we go through Bill's extensive background and experience in short selling and his successes, over the past 30 years of his career. But I thought with the global pandemic that's now threatening to burst the asset bubbles the Fed has blown over the past several years and now forcing central bankers into even more extreme monetary policies, this would be an opportune time to reconnect with Bill, get his thoughts on how these things are evolving and how investors might seek to profit in their midst. So without further ado, please enjoy my conversation with Bill Fleckenstein.
Ever wonder why fund managers can't beat the S&P 500? Because they're sheep, and sheep get slaughtered.
Hey, Bill, welcome back to the show.
Hi, Jesse. It's nice to be back.
Yeah, I can't believe it was almost 3 years ago that we did this for the first time. I got to thank you. My wife is now a huge white burgundy fan, and finally started getting some decent wines for her. But now she won't drink anything but white burgundy. So thank you.
So I cost you some money, obviously.
Yes, yeah, but it's a good thing. It's a good thing to have some decent wine around the house. Speaking of that, I've got myself here a glass of Willamette Pinot Noir that I'm drinking. You have something on your end over there?
I'm actually having a beer. It's
Perfect.
It's pretty warm out. Oftentimes a beer tastes good. I'll switch to wine. I never drink more than one beer. After that, they don't taste very good. Half the time, I don't even finish the first one.
Yeah, I'm not much of a beer guy. Living in Bend, you think I would be. I think we have more breweries per capita than anywhere else on the planet. But I can have like one beer and that's about it. But anyhow, I just figured since last time we did this in person and we had wine, why not try and recreate that even if we can't be in person? So, I was thinking about preparing for this conversation, and there's a quote from a Stan Druckenmiller interview that just has been stuck in my head. It's from that Lost Tree speech he gave, 5 years ago or something, where he says 80% of the big money we made was in bear markets and in equities because crazy things were going on in response to what I would call central bank mistakes during that 30-year period. And that's a real loaded quote, but I think it pretty well describes your career as a short seller, no?
Well, yeah, except for Stan's so much smarter than me, of course. And which I've actually been at a dinner with him a couple of times with some other guys, and but he made money not so much shorting, although they did make money being short. He would just load up on bonds, right? So it was, and for all I know, there was FX trades that came out of that. So it was more the ability to leverage up bonds and maybe FX to make money in the bear markets as opposed to being short. I mean, obviously, a lot of stocks have declined rather dramatically, but it is really difficult to make money being short when you're having to fight these massive liquidity injections. I really not even trying very hard at all because, they're rolling out these new facilities and $2 trillion. I mean, first of all, look what QE did. It took the market to the moon for a long time. They tried to back off. The market started to wobble. They came back with more. Then they came with the repo facility in the fall. Now they've started all this stuff. So it's just there's no roadmap when they're doing all of this. All of this monetization, and of course they're going to be bringing more fiscal stimulus, and the Fed has trained people to believe that nothing bad can ever happen when they do all this monetization, and they don't think about the fact that what they've done is they've sort of talked without talking cities, states, entities into just kicking the can on all problems, right? And so there's this huge brewing pension problem. There are all sorts of warped bits of thinking about what's possible. So, for instance, they're starting to buy munis. Well, what's to stop the states from saying, hey, Fed, just monetize this directly? They've led people to believe that the printing press can solve all the problems and there's no downside. So nobody tries to solve problems. They wait for the consequences of the money printing to cause trouble, and then they turn around and do it again. So now, obviously, this crisis was brought on by the pandemic, but the epic bubble that we've been living through is the reason why it's such chaos, and it's going to be more so. So, long answer. I think shorting is extremely difficult given the MO of the central banks.
Yeah, and you tweeted a great article, I think it was last week or earlier this week, about these kind of central bank mistakes. I think it was the opening lines were something to the tune of, the coronavirus didn't create this crisis. It's just a catalyst for a crisis that's created by the Fed. So let's talk about the crisis that we're facing now. Obviously, is not just a health crisis; it's another financial crisis. But what were the mistakes that the Fed made over the last 10 years that put us in this position?
Well, it's been a slowly evolving, bigger and bigger issue. I mean, right? After the Greenspan's mistakes in the late 90s, which I think I captured in my book, and then we had the early part of the 2000 to 2010 period. The Fed didn't get blamed for the economic damage that was caused by the burst bubble because they pinned it all on 9/11. So then they cut rates and they did all that, and then they created a housing bubble, and they cheerleaded for that, and I actually covered that in the book. But then after that burst and nearly took down the financial system, they started doing QE, and they said they could stop and all that. And of course they couldn't. Remember when they tried to stop, the market started to wobble and they had to back off. I mean, they did get away with it for about a year, but basically, I think it was Kyle Bass who first noted that you can't leave NERP and ZERP, and you can't leave QE. I mean, or get very far trying. So, the Fed just created this false sense of everything's okay. They forced rates to be at zero. And when I say the Fed, the other central banks did the same thing. They forced rates to be at zero. And they got people complacent. And so we had the problem with the ETFs being bigger than the underlying securities and vol selling and all these. We had all this crazy stuff that mimicked portfolio insurance. And then instead of the bubble exhausting itself and taking itself down, which is what usually happens, and then spilling out into the economy and having all those things, the bubble was burst by basically a nuclear weapon in the form of this pandemic that basically stopped GDP around the world. So it wasn't just like the bubble just got pricked. I mean, it got obliterated, and so did the economy. So you've got this really wild cross currents between the pandemic and the panic over that, which I think we've passed the peak panic. Now we're going to struggle with how do we reopen the economy, and then the bounce back of the pandemic and all that sort of thing. So there's that. But and then there's the economic damage. And I don't think people have really gotten their heads around how extraordinary the economic damage is and is going to be.
Well, yeah, and it's, I guess it's a testament. You mentioned the dramatic steps the Fed is going to or has gone in the last couple of weeks, and I think you recently wrote that it's far beyond anything you imagined, and especially how quickly they've unrolled it all. You've been writing for a few years that when we get another bear market, the Fed is going to pull out all the stops. They're going to start doing X, Y, and Z. But the fact that they have to start buying corporate bonds and things right now is due to the fact that they encouraged so much debt creation over the prior 10 years, right? I mean,
Absolutely. You said that perfectly, Jesse. It's just so bizarre that, my friend Jim Grant came up with this brilliant analogy, which I steal all the time, that the Fed, they are the arsonists, and they always get credit for being the firemen. and they're the ones that create the mess in the first place, but they never get tagged with that. And at some point that will change. I can't say exactly when. I have a hard time believing we're going to get through the next year or year and a half without people seeing what a reckless mess they are. We have to understand there's like two generations of investors that don't know anything but these crazy policies that they pursue. They've never taken any pain. There was let's say you started the investment business in 2001. Well, you've been at it for 20 years almost. That's a decent amount of time. You had about a year of pain in 2008. And if you've been in it for almost 30 years, you had a year or two in 2001, 00 to 01, and then 08. So you haven't ever seen any real pain, and you've been able to draw conclusions about how markets work, which really aren't true. They've only been true in this activist central bank era that we have just come through and are still in. And while 20 or 30 years is a long amount of time in a person's lifetime, it's not really in history or economic history. So when they look back and they'll write the history book, they'll say, God, there was this period that went on almost 25 or 30 years where they thought that they could print money and it wouldn't matter and all this stuff. And then of course, it will have blown up, and they'll write a different outcome, and they'll relearn the lesson. You can't do these things. But while you're going through it, these people think it's painless. So if you were the average portfolio manager or investor, and you'd read somebody like me or somebody else who is critical of the Fed, and they'd say, yeah, but look, it works. It works. They don't see. It's sort of like, people thought Oxy worked just fine until they found out that it was wildly addicting and it ruined lives, right? That's a little severe, but the point being, while you're going through it, when bad policies, a lot of time, the lead time between when you're pursuing the bad policy and when you have to pay for it can be 5, 10, 15 years. And so people have a hard time connecting the policy that created the bubble with the burst that comes later. I guess that's the best I can come up with.
Yeah. Well, it's a great point that, so many investors have not seen anything but, Fed blown bubbles. I think, what is it? The NASDAQ had one down year since 2002. I think that's right.
What? If I drew I'd be surprised.
I think it's one down year.
I'd be surprised if that's not right.
Yeah. And so, people have, we got 16 up years and one down year during their, 17-year career. The only lesson you can draw from that is, the Fed is going to prop this thing up, and they can do it indefinitely. And you hear that, right? You hear that narrative from investors all the time. Markets can't go down as long as the Fed's doing what they're doing.
Right.
But to me, it really comes back to, Congress gave them this dual mandate, right? Whatever it is, moderate inflation or prevent inflation from getting out of control, but also full employment. And so the Fed has taken it upon themselves to say, we're supposed to prevent recessions. We're supposed to not allow recessions to happen. And it comes back to this firefighter analogy, right? Imagine I think we learned through fires, here in the United States, that trying to prevent all forest fires is a really bad idea, right?
Right.
And
Right.
that's what the Fed is doing, right? I mean,
Right.
is
Well,
and by trying to prevent all these recessions, or every time a recession hits, trying to immediately create a recovery instead of allowing any
okay,
type of washout.
let's
Yeah, go ahead.
let's expand on that. Okay, so the people that have been trained by the actions of the economy and things that the Fed's done for the last 20 years arrived at the moment the pandemic hit with no savings. We've all seen the data, although probably nobody knows where it came from, that said the average person has $400 in savings. It doesn't really matter what the number is, but the fact of the matter is, generically, people have sort of lived hand to mouth, and they haven't felt the need. There's been no reason. They haven't really thought through, well, why would I need to have savings? Everything's going to be fine, or whatever. They've been trained in a manner that goes against actual reality. Historically, we'd have recessions every 4 to 5, 6 years for a variety of different reasons. But usually what it boils down to is people get a little careless, they get a little sloppy, they make mistakes, something comes along, they have to retrench. But they learned along the way that I got to keep a cushion. I got to be prepared for something bad to happen. And of course, guys that are your age and my age, our parents or our grandparents who were younger could tell us about what the Depression was like, when people really, struggled. There was obviously it was a horrible period economically, but the lessons that people took away of having savings and just be prepared for something bad to happen. People have lost the not necessarily the knowledge, but they haven't felt that there's been any need to prepare or just in case, right? And so I think the consequence of going 20 years with one down year, basically, or 18 years with one down year, has taught people not to be prepared, not to save, not to really save. They've taught them, and speculation is fine. A lot of people have thought they were saving and they were actually speculating. So these are all sort of some of the subtle and pernicious consequences of the policies that the Fed and the other central banks have pursued, where they've tried to ensure permanent prosperity. And then you get these, so all this crazy behavior. And then when it gets rocked by something like this, no one's prepared. And the economic damage is just going to be so bad, so brutal for so many poor people. I feel so bad for so many of these people who, you can't expect everybody to be sophisticated, but you can, I think that they expect that the people running the show, so to speak, aren't completely incompetent. And you know what? They're wrong. They are.
That's a great point. That we've had moral hazard, with investors and with companies that have thought, I don't need to, to prepare my business or my portfolio for a rainy day because the Fed and the whatever will come right to the rescue. But you could even maybe say that for individuals too. They've said, if something happens, the government and whatever, they're going to come to the rescue too. And so I don't need to think of in terms of cycles anymore. That's one of the consequences of all this.
I don't know that people actually necessarily thought that through. It just kind of what evolved. Do you know what I mean? Because if you would have really thought, gee, do I need to keep some savings? If you actually thought about that, you probably would. But I just think it's like the farthest things from anyone's mind. I mean, nothing bad ever happens. Why do we have to worry about it? You know what I'm saying? It's just like,
yeah. How many times did we hear over the last couple of years? Right, we had just had the longest economic expansion in however long, and that encourages people to think, well, maybe this could go on forever. You have Janet Yellen saying we've seen the probably the last financial crisis in our lifetimes in 2009. You have all this kind of rhetoric of maybe the Fed has ended recessions. Maybe they've actually found a way to live up to their mandate. It's amazing.
Yeah. So what used to happen when we'd have these quaintly called the economic cycle, and we'd have recessions and recoveries or booms and busts. But through those things, people learned, they learned to be careful, learn to do things differently, keep a cash cushion, have a decent balance sheet, not to speculate too much or whatever. And you had to, you had to learn and you had to be smart to navigate your way through these different business cycles. And now it's just been, an exercise in getting long some speculative security and hanging on for dear life, right? Which that worked. It's not exactly a thoughtful strategy, and even right now, still because of all the money they're printing, those FANG stocks arguably are extremely expensive. But I'm not saying that. Amazon does seem pretty well situated, but I don't know if it's worth what it's worth. I'm not trying to advocate for that, but the fact that there's been sort of this mindless adherence to anything that goes up, valuations don't mean anything, and so that also has led people to be kind of careless about how they look at their finances overall, I think.
Yeah, and that's a consequence of the Fed, I guess, encouraging an economic expansion. We probably should have had a recession in 2015-16. Some people argue that we did, and the Fed rode to the rescue. Then global central banks to kind of prevent any type of even a mild downturn at that time. What is there a consequence? To come back to the firefighting analogy, when you prevent forest fires for a period of time, right, and allow all this detritus and undergrowth and all this stuff to kind of build up, you create the risk of a much bigger, more damaging fire when it eventually comes. Do you think that's where we are now because of these, policies the Fed's pursued for the past decade plus?
Oh, without question. There's just no end in the aggregate. Essentially, no one's prepared. The cities aren't prepared. The states aren't prepared. There's just the concept of fiscal responsibility is the farthest thing from anyone's mind anywhere, except for some people with gray hair that have been through enough stuff and have read enough about financial history. So the Fed has basically penalized you so aggressively for being prudent that they stomped it out of people's behavior. You've been rewarded for being speculative, and you've been penalized for being prudent or frugal. So anyway, they created the landscape such that when this virus hit, and basically, created an instantaneous depression, basically, people came into it as unprepared as they possibly could be. So now the question becomes, okay, what's going to happen prospectively? Because how soon we open up and how fast we open up, that's in the hands of the politicians. And I'm not going to pick on anyone specifically, but generally they're incompetent. I don't care whether Democrats, Republicans, where they are. Now, not all. There's now and again you see, the occasional politician that's actually smart and can make decisions. But my big fear is, because my biggest worry, forget being a bear or a bull on this or that, my biggest worry is the economic devastation that's going to happen to so many people because of the depression that's been caused by stopping the economy to deal with the virus. And I think that the average politician is more concerned about the incremental coronavirus death than they are with the bankrupting of many more companies. Families through bad economic because of the horrendous economy, right? So that's my biggest fear right now. When I think about what's going on, is how are we going to deal with the whole reopening, and are people going to make intelligent decisions? When I look around, I'm afraid they're going to make a bunch of political expedient decisions for themselves. You're the governor of a state, You're worried about getting criticized when you reopen, when there's going to be more deaths, because there will be. But I don't think you feel like you get criticized if 5 million households in your state basically go bankrupt. Then you get to blame that on the virus or Trump or the bubble. And so I think that's the biggest danger is going to be economic mismanagement on the part of politicians going forward. And then you combine that with the insanity that the Fed's created, and it's a real problematic mix.
Yeah, well, that's what I was going to ask you is, we were talking about the central bank mistakes leading up to today. I was going to ask, what are the central bank mistakes they're making now? But it's a good point that it's not just central bank, it's the fiscal mistakes too that are potentially being made. And, that brings up the whole MMT, thing that we're witnessing right now. I guess there is the risk of politicians making these mistakes based on wanting to get reelected versus what's the right thing for people and the economy. But it seems like the Fed is kind of stuck just aiding and abetting these policies no matter what they are, which is maybe the mistake the Fed's making now too, is that they've become beholden to fiscal. What do you see as the mistake?
Well,
I guess the monetary mistake.
Pretend you're a politician. There's been no consequence to running up big deficits. There doesn't seem to have been any consequence to printing money because they don't see the economic damage from the bubble. They just blame it all on the pandemic. So they've all been trained that nothing really matters from a fiscal or monetary standpoint. So they're all going to push for the government to do more and more and more. They spend trillions at the drop of a hat. Everybody's for it because why not? It doesn't have any consequence, so they think. Now, we haven't gotten to the part where the bond market doesn't work anymore because of what they've done, and that's for down the road. But again, it's part of the danger of the Fed enabled that the can to be kicked on lots and lots of different issues. And now when the economy stops and basically, entities all go broke, then they look to the Fed to do more. And of course, the Fed does more, and eventually they'll do way too much. But again, the Fed created the problems in the financial landscape, and those are bad. But again, the real danger to them is what happens next on the economy, and we just have to see because they're gonna. Some places they'll be very slow to open up, and they're going to do tremendous damage. And other places they'll open up sooner, and there'll be rebounds in the virus, and people will freak out, and we'll have to see what happens. This is it's going to be so much trickier, I think, than what the stock market's discounting. But again, you don't know what the stock market's discounting because the Fed pumped in $2 trillion, in less than 5 weeks.
Yeah, well, and that's a great point. Let me ask you this: the Fed, went, far bigger than anything anybody imagined. I think you could argue they learned their lesson from the financial crisis rather than kind of, saying, hey, is this big enough markets? Is this big enough economy? And then having to get bigger and bigger to finally find the level that was enough to kind of put a floor in for stocks, which, is also arguable whether the Fed had a role in that or just an accounting change. But they decided this time we just have to go huge right out the gate. You suggest, and I think it's absolutely reasonable to expect the economic malaise is going to be not just deeper, but so much longer. We're not going to just reopen and go back to where we were in February. We're going to reopen a piecemeal, and there's still going to be social distancing measures, and the virus might make a comeback, and it's going to potentially take a long time.
Guaranteed the virus may come back. The question is how manageable it turns out to be, but for sure it's coming. It's going to come back.
Yeah, and so I guess my question is, the Fed has already gone so much bigger than anybody thought they would go. What if they have to go that much bigger and for that much longer over the next year, 18 months, 2 years? it could get so big that it's already beyond imagination, but it could get so much bigger even.
Well, and they look, my long held theory, and we probably talked about this 3 years ago, had been, I knew that when this bubble burst, they'd come back and do what they've done. I obviously didn't know it was going to be a pandemic, and I didn't know that they'd get away with it as long as they did, but that's how it's worked out. They're going to continue to do this until the bond markets stop allowing them to do it. In the old days, the currency markets would have stopped them. But when all G7 countries are doing the same thing, they're just various flavors of the same bad paper, right? There's no real difference between any of these currencies because they're all doing the same crap. So at some point, it's going to be up to the bond market to say, I don't know if I really want to own these. Now, if you're a pension plan or an insurance company, how are you supposed to diffuse these long-tailed liabilities with a 10-year bond that yields 60 or 80 beeps? There's nothing there. Now, for a while, it kind of worked because guys, were hopeful rates could go to zero or negative, which is insane. But I just think at some point it's going to change. And I thought it was interesting that Jeff Gunderlock, he had some webcast recently where he said, there's no value in bonds anymore, and there aren't. They've been reward-free risk for quite some time, but I don't know what's going to happen, but somewhere along the way, there's going to become a moment in time where psychology is going to change, and maybe it's when we're issuing, when the deficit gets to 3 or 4 trillion, and it all of a sudden, inflation has picked up because that's liable to be on the other side of this depression, the bottlenecks that we hit, and people have been sensitized to not being able to get holds of things. Psychology's changed. I mean, who would have thought people would hoard toilet paper, for instance? But that's a mindset of, well, maybe I better have some just in case. And when you start to get people to think like that, and they start looking at these policies, and we get on the other side of the opening and start to see the bottlenecks and things, and people start to say, well, I mean, the Fed is telling you that 2% inflation is not enough. Okay, now I know no one's worried about inflation right now when oil's trading at zero, literally, at least in the front month. But there's going to be more inflation. The Fed has decided that when inflation gets to 2, whenever that happens, they're going to say, it's okay, we don't have to worry about it because we need to make up for past. So at some point, the bond market is going to say, we're not doing this anymore. You're going to offer me, some handful of basis points for 10, 15, 20 years, and you're going to make inflation 2 at least, and you're going to let it. And when it's running high, it was running higher than that anyway. So somehow they're going to lose the bond market, and that will stop this lunacy, and then that's going to be a real train wreck. Of course, I don't know when that's going to happen or how it's going to come about. And then you also have to think about the debt jubilee idea. I mean, Japan could pull that off now. Japan could the BOJ could say to the MOF, hey, let's tear up that paper. The MOF could say, we'll give you, because they own 44% of or some number like that of the Japanese bond market. They could just say, well, we'll trade you in a 200-year piece of paper at 1 basis point, and basically they get rid of the debt. So there's a possibility that somebody may try debt jubilees, and that could be the thing that changes psychology. All I know is this: when you're printing trillions, and you want 2% inflation, but you'll take higher because you think you haven't had enough, which they've all said. We've been behind. Look. At some point, and rates are like sub 1. At some point, bond markets are going to crack up. It's just math. And on the subject of this 2%, the Fed's mandate was stable prices. Jesse, that's the mandate: stable prices. They concocted this 2% inflation bullshit because they are so stupid that they think inflation leads to economic growth. It does not. Inflation can be a consequence of economic growth, and often it is when it has been in the past when they've done things wrong. But you could have a brilliant economic recovery and have deflation if you had enough, gee whiz tech stuff going on. So they're so wrong-headed about that. In any case, I got ahead of myself, but they're going to lose the bond market at some point, and then there's going to be hell to pay. I just don't know when that is.
No, and that's a great point. I mean, I think we've seen, deflationary periods throughout U.S. history, and they've not been, detrimental to the economy. I was hoping you'd bring that up. That stable prices doesn't mean two; it means zero. But to come back to this losing the bond market point, this is something I absolutely agree with you. I think it's it's inevitable. But I guess the question is, what does that look like? What does it look like when the Fed begins to lose the bond market?
I don't know, but I can tell you what the consequences are. I'll sketch it out for you. I'm making this up, but it's plausible. So let's say we're down the road later in the year, and we've got the economy reopened. It's kind of sputtered. There's more cases, but we can see that it's manageable. And we're going to get on the other side of the pandemic, and now there's broken supply chains and all this kind of stuff, and we're moving things out of China, and the inflation rate starts to pick up. And maybe the bond market starts to back up. And let's say because the economy is still weak enough, because we've just gone from depression to severe recession, the bond market's not doing what the Fed wants. And the Fed decides, you know what, we're gonna exert yield curve control. So we're gonna peg, everything out to 20 years at, the 10 years is going to be 60 basis points, and we're going to peg the curve along various spots. Basically, what they'd be saying is the bond market doesn't really like the price it's at for whatever reasons, too much stimulus, more inflation. But the Fed says, but we don't want the bond market to raise rates on us, so we're going to suppress it. So they would be actually pouring gasoline on a lit fire. Basically, the bond market would be objecting to what they've done as being too stimulative, too provocative for inflation, however you want to say it. But they would then try to stop that revolt with the very thing that was causing the revolt, i.e. too much easy money. That would exacerbate that problem. It would enhance the inflation rate. It probably exacerbate inflation psychology. Now all of a sudden they can't print money anymore because printing money is having the opposite effect. Now, it's hard for people to get their heads around that because what they've seen in the last 20 or 25 years, but that could easily happen. Then all of a sudden, when you can't print money to get out of the problem, then you could have a real depression. Then you'd have to deal with all the unfunded liabilities and all that stuff. But of course, now you've let them get worse over 20 years while you kick the can when we could have done this after the first bubble burst or the second bubble burst in 2008. So that's what it would look like. But then the other side of it is we have to see it could be that Japan tries the debt jubilee. And how does that play out? And I don't really know because, and we could try that here. So I don't know. I can describe how they could lose the bond market. I could see how it's plausible. I could see inflation psychology having changed after people have been through this pandemic. They start to think about what could go wrong and higher prices, and they could see prices going up, and they're more sensitive to it than they were before because they're all on tighter budgets because they were all, people lost so much money by not working. So that's how it could happen. And, it could happen this year for that matter. I don't know that it will, but that's how it could play out.
Yeah. Well, let me ask you this. How likely do you think it is that, or was that, the troubles that we've seen in repo over the last 6 months, 7-8 months, could that be those early warning signs of the Fed losing the bond market?
Absolutely, Jesse. Thank you for bringing that up. I forgot there'd been so much crap that's gone on that I kind of lost the thread. Yes, basically, that, in my opinion, was the early stage of it, because basically what happened was the budget deficit got so big that the primary dealers couldn't finance it with the rules that came out of Graham Dodd. No, am I quoting the right bill, or am I a bubble back? No,
Dodd-Frank. Yeah, no, you're close. Yeah,
right, exactly. I was thinking of Graham and Dodd. the farthest thing possible from what's going on.
Time to switch to wine.
Yeah. So no, that was the early indication. And so what I thought was happening was the Fed was they had to get in and monetize, create a repo facility, basically to allow the deficit to be funded. And just about the time people were starting to talk about that, and it might have actually mattered to how people perceived what the Fed was doing, then all hell broke loose from the pandemic. But you're right, no one's eye is on that ball anymore, but I think that was potentially the start of that. And of course, now there's so much going on that people aren't really focusing on it. But yes, there was too much. Sorry, the demand for money at the prevailing price was too high, such that the dealers had to finance it, and they could because of the short end of the curve, but no one had the balance sheet for it. If there had been enough going away buyers, said differently, if the market liked that rate and was willing to accept it, the Fed wouldn't have had to do what it did. So the Fed basically was forced to step in because the bond market was backing up due to too much supply at the wrong rate. The one they were mitigating.
Yeah, and so for me, it reminds me. It was a couple months after you and I sat down to talk about this stuff. I was fortunate enough to have William White come on and ask him some of these questions. And he pointed out, kind of in terms of this, the monetary policy can go so far before they potentially lose the bond market or something like this. But his point was, monetary policy can kind of in a vacuum do whatever it wants without creating inflation and whatnot. It's when fiscal policy starts to become out of control that you start seeing fiscal dominance, and the Fed is basically put in a box. And I think, to me, it seems like that's potentially what we're seeing, which, it took a $1 trillion deficits, again, during an economic expansion to start blowing out the repo market. And now we're going from a $1 trillion deficit to who knows what we're going to be today. People are talking 16, 18% of GDP or more, kind of, and the Fed being forced to monetize that. We're kind of in uncharted territory here for, at least U.S. history.
I think the biggest variable is psychology. If people perceive it to be okay, then it's kind of okay. If they start to worry about the consequence, and I think that, people look, I hear people say, well, QE didn't cause inflation because it stayed in the stock market. Well, you know what? That inflation, they created the excess money and it went into stocks and art and it went places. It didn't go so much into daily life, but that's kind of that's a function of where the money went first, and people's psychology was they weren't too upset about it, right? So if psychology's changed and people look at it differently, the psychology is what changes the M's, not the M's change psychology, if you know what I mean.
Yeah. Well, and you wrote recently, you feel like psychology or that we're at an inflection point with inflation psychology. Expand on that a little bit.
Well, again, there was more than 2%. Let's go back to last fall let's go back pre-virus. There was more than 2% inflation. Well, we don't know what the real number is because the cost of living is such a badly calculated index. What with the dramatic effect that hedonics has, and since technology products are such a big deal in everyone's life, and those productivity gains have been so huge, but hedonics has held down the price in the CPI of lots and lots of different things. And then you've got substitution, and you've got the way they calculate house prices and things like that. So the CPI has been constructed so that it's very difficult to show any inflation. But so it never showed much. But I think that anyone that has to pay bills knows that net inflation was running over 2%. Almost like the poorer you were, the higher it was, and the wealthier you were, the lower it was. So inflation was already well past where people should have objected to what the Fed was doing, but nobody seemed too concerned. I guess because the economy was kind of percolating along and the stock market was strong. But it was one of the reasons I believe one of the reasons the middle class has been so eviscerated is because a lot of them don't get the real benefit of the stock market, maybe to some degree in a 401k, but they pay the price of the increase in healthcare and tuition and services and all these other things that don't get picked up very well in the CPI. So inflation has already been running too hot. And then when you come into the virus, and then people have a lot of time to spend at home. They're thinking about their money, and they start thinking about things differently, and they have to panic and hoard toilet paper and other things. It changes your mentality, and you start to look at things differently, and you say, well, what's going to be the next spot shortage? Could it be pork? Could it be beef? Could it be chicken? We read about these giant, we've created these giant supply chains. And everyone's lived on just-in-time manufacturing. In the old days, people used to have just in case something went wrong, right? And then all switched over to just-in-time because nothing ever went wrong. Well, now things have gone wrong, and people's psychology can start to change about that, and they look at things differently. And then they're not so comfortable with the same policies that they were comfortable with before. So I can see that's maybe starting to happen, and I can certainly see why it could pick up some steam. And if it does, then the Fed has got a real problem. That's how they wind up losing the bond market.
Yeah, it's a couple great points there. One is, that inflation is probably not 2%. It's so, it's such a bastardized calculation of inflation. There's a couple interesting sites. I think if you just Google shadow stats, you'll see if you calculate inflation the way that it was calculated in 1990, we're running at 5-6% inflation. We have been for the last 10 years. So, but then, your other point to inflation psychology is so important because it seems like inflationary episodes are driven as much by inflationary psychology as much as anything else.
Absolutely. Listen, I will. Let's think about. Let's go back to 79 to 84, just because I lived through it. So in 79 on Saturday in October, Volcker raised interest rates 200 basis points overnight. And he was trying to convince the bond market and the world that he was serious about inflation. So here's how much the world believed him. The price of gold basically doubled between October of 79 and January of 80. They didn't believe him. So then, we went through 80 and 81 and rates were, I think the high end on treasuries was around 16%. And then finally, in 81, the psychology started to change, and the market recovered in 82. But by 84, the economy had been doing well, and the bond market, the rates backed up to 14% in 1984 because people were so certain that raging inflation was going to come back. It wasn't even close. But that's what the mindset was, and that's how powerful it can be. So the mindset has been, just as powerful in the other direction, that it can't possibly happen. I mean, no matter what happens, you see people forecasting deflation, right? I mean, I saw an intelligent person who shall go nameless recently making the case that inflation was deflationary because it robbed people of purchasing power.
It's go ahead.
No, that's how dug in this deflation. I mean, I hear people yapping about deflation all the time. It hasn't happened. That's why they run the printing press. And you can have collapse in asset prices, real estate. I mean, we've just had a big collapse in the price of oil, right? But that's not going to take down anyone's tuition. That's not going to help healthcare. Do you think healthcare is going to be more expensive or less expensive after the coronavirus incident and what's happened to these hospitals? So the price of most everything is going to go up, and people are focused on deflation because the price of oil collapsed. I mean, so anyway.
Well, I love the to look at this as the inverse of that period you were talking about, where Volcker was raising rates and nobody believed that inflation was going to come under control and that he was going to be able to tame it. Nobody believes, the Fed is now saying it's the exact opposite.
Right.
We're going to do everything we can to spur inflation and stoke inflation, and nobody believes them.
Right.
It's exact inverse.
And by the way, what do you think's harder to do, to stop it or to start it?
Right.
That's
a great point.
Stopping it requires draconian interest rates and credit constriction. Promoting it is party time, free drinks for everybody.
Yeah. Yeah, I got to ask you, I want to kind of bring this back to the stock market again. You were talking about the FANG stocks a little bit, but, you've talked about this as at some point the bond market's going to take the printing press away from the Fed. I've looked at it as, the Fed is going to have to make a choice between the devil and the deep blue sea.
Mm-hmm.
The devil is the devil, that's an asset price bust. We've seen that twice in the last 25 years, and you're going to have to just allow that to happen, or they're going to try and save the market, and in the process we're going to see the deep blue sea, which is inflation just takes off beyond their control. And I've seen that as kind of just a dichotomous choice they're going to have to make. But now I'm at the point where I think they might get both. They might get an asset price bust and inflation taking off at the same time. I mean, where do you kind of stand in that realm?
Well, if they lose control of the bond market, they will get an asset price bust. Because if you can no longer monetize your way through problems because people are worried about the consequence of monetization, then you can't print. That means you have to deal with problems. That means you're going to have a horrific recession and brutal while you wring out the excesses and figure out how you're going to pay for all the debts that we've run up and the long-tailed liabilities that people will be focused on. So, if the Fed didn't have the ability, well, just look at right now. The Fed couldn't print or didn't print if they didn't come with the repo facility and the $2 trillion they've just come with. There's no way the government would have had the idea that it could just come up with a $2 trillion package and another $2 trillion package at the drop of a hat. It's the belief in what they're capable of doing has caused us to believe that money printing can solve everything. Whereas it can't, and we're going to come out. I don't know how much worse the finances of the government are going to be at the end of this year when we do all the things that they're going to wind up doing, but it's going to be pretty horrendous. It's impossible to speculate how bad things could get if they weren't able to do this. But I just wanted to share the psychology is if they lose the psychology and the confidence of people in the bond market, we're in for a world of hurt, because I showed you, they didn't believe Volcker after he'd done the right thing. He'd done all the right things. And in 84, they still didn't believe him. And the rates backed up to 14%. Inflation was running like 4-5 at the most, right? So the 1,000 basis points of real return. People didn't want them because they were so convinced. That changed. But that's what can happen. If people lose confidence in him, it's really, you can just let your imagination run wild as to how bad it could be.
Yeah, and I guess, my question is, to go back to that earlier period, it feels to me like we could be facing another kind of stagflationary environment where we have a painful recession, but it's not necessarily, it could be disinflationary in the short run with the oil price crash and a dramatic drop in just demand from forcing people to stay home and not work. But it seems to me that this is going to linger even once we reopen the economy and all this kind of stuff, that it could be a stagflationary type of environment for a period of time, which would force people to lose confidence in the Fed's ability, in terms of not just the bond market, but also the stock market. You lose confidence in that Fed put.
I think that's the highest probability outcome, Jesse, is stagflation.
Okay. So in terms of the stock market, then, last time we talked, as a short seller, who's somebody who's very nimble and tactical, and patient in that regard, because you have to be with what's going on. Are you looking for that opportunity to shoot him in the back, as you like to say?
Well, the amount of monetization has kind of taken. This rally, when it rolls over, would be the classic shoot him in the back opportunity. But, again, I don't really know how to read the tape and what to expect with the massive amount of stimulus that they're applying and other central banks are applying. So I've been running my short strategy, so to speak, by being long gold and gold miners, because I felt that, and I imagine we probably talked about this a few years ago, although maybe I hadn't got that committed to it yet then. I've just felt that because they're always going to err on printing too much money until the bond market takes away the printing press, that the things that make me want to be short, I can express my views on that by owning gold, or in this case also gold miners, because of the valuations there and the prospects for their businesses. So I've sort of not tried to be short because it's been so difficult, and rather be long gold and gold miners, and that's actually been a better way to do it than trying to be short. Now I know there are a lot of smart guys that made money in being short retail and maybe the oil patch and all that. But again, I just, and I look at the destruction of those stocks and think, wow, I could have been in them. But I've always kind of been involved in tech stocks, mostly on the short side. And that really still hasn't worked. I haven't really tried because it hasn't worked. So I just think until the bond market really decides it doesn't trust the Fed, I think you'll make more money being long gold and gold stocks than you will being short, generically, not specifically. I'm sure that some guys have made tons in certain areas, like I've noted, but I just think it's just easier. It'll be easier to do it this way.
Well, that's a fascinating answer, because we started out the conversation with that Druck quote, and you said, well, he didn't make his money shorting stocks; he made it through bonds and FX. And sometimes the highest probability trade is not just shorting the stock market. There's a better way to express it, and that's what I hear you saying with gold is there's a better way to express this trade about the central bank mistake. And that's just through being long gold. Right.
Gold. And I think silver at some point will really catch a bid. And the thing of it is that, the gold stocks have been so, they had a period in the first run of gold when it went from 275 to 1800. A lot of them expanded somewhat carelessly, and so they really got pummeled in the gold bear market when it traded from 1800 to 1100 or wherever the hell it went. And now people have been sort of nervous about taking an interest in them when a lot of the companies have been really well run and cleaned up. And so, there have been various times I've looked at it and said, well, I can make 50 or 100% in these miners without anything really spectacular happening. It's going to be easier than being short. Now, it hasn't been all that easy, but being short hasn't been all that easy, save for this last little break or big break we had. But then there's been a hell of a lot of motion around that as well.
Well, it's funny. It is a big break, but it feels like a little break compared to the huge bull run that we've seen in the last 10 years. Is there any type of action, that you would in the stock market that would get you excited about the short side?
I'm sorry. Can you say that again? I'm not sure.
Yeah, no. Is there any type of action in the broad market or in those tech stocks that would get you excited about the short side?
Well, again? If you look at the S&P, for instance, if it were to roll over around here somewhere, it could look like a failing rally. I'd be tempted, like I'm kind of paying attention, and if that starts to happen, I will probably take some action, but I don't know how aggressive I'll be, because the market starts down 5 or 6% and the Fed rolls out another $1 trillion, and the next thing you know, this thing's limit up again, right? So there's some stuff. The first stock I would probably pick on is Apple, because I mean, it's hardly been dented after the huge run, and you got a $1 trillion plus valuation, and I don't know what the estimate is right now because the estimates are all no good. But I mean, it's probably. Let me just look here. I was going to see what it's. I can't remember what its trailing earnings are. Let me just give me 1 sec. Just 1 sec.
Yeah, I looked up its price to sales ratio. It's trading at its highest valuation in 10 years right now.
Yeah, the price to sales. So it's just 20 sometimes earnings, and people could say, well, the market's but look, you're paying 20 times earnings for $1 trillion company that didn't really have much growth, and now you've got the world's decimated from an economic standpoint. Nobody's going to race out to buy a new phone. So I don't know what the right multiples should be. I don't know what the right earnings estimate should be, but I just know that it hasn't really, and by my eye, really been dented much by this decline. I mean, okay, it's what it declined from, 320 to 260, but it's right where it was in December. It's still where it was in December. Does the world look anything like it did in December? So, I mean, and like Tesla's a cult stock. It's a complete joke, but the thing levitates. I could find lots and lots of these kind of things. If those things started to take on water, and it kind of looked to me like, oh, they're finally getting to these things, they're going to have to price them like businesses instead of cult, talismans. Then I would find a bunch of stuff to do, but. Is that going to happen? I don't really know. And it would need to set up. It needs to set up in a way technically and from a fundamental standpoint where I would feel really comfortable, because it's so dangerous. You can't really develop a thesis about how these things are going to play out because the Fed gets in the way. And when they print money, then people believe in fantasies. Last year was going to be a second half recovery for a whole group of things that never really happened. It was going to be this year, but now it's not going to happen because of the virus. And some of those companies that were going to get the second half rebound didn't get penalized. And then, of course, you got in the chip sector, you've got, you got some hoarding going on in China because they're worried about the ramifications of what Trump may do post, this moment in time we're in, because in retaliation for what they for not getting on the virus. So then you've got there's so many weird signals coming out of, say, the chip supply chain. It's hard to get a real bead on what people are thinking so you can figure out how you can take advantage of that. So I just find, the degree of difficulty factor is so extraordinarily high that I really need a really juicy setup, which I can't really define to you in advance until I see it. Some combination of technicals and fundamentals that make it look like now the thing's going to go down, and then we'll maybe flush the low from March, and then you could get a real waterfall. But they're going to step in and try to arrest that, so you're going to have to be nimble. You can't really invest on the short side right now, in my opinion. You just have to trade it.
Yeah, well, I like your point of watching the speculative favorites, because we saw an incredible euphoric blow off it was like 50% more call buying than we've ever seen in history, and a lot of it focused in Tesla and Virgin Galactic and these kinds of things, and they're still catching a bid, and so for when you start to see those things roll over and that speculative euphoria start to really take a dent, that might be the signal. So I like that.
That's kind of what I'm kind of looking for. But even there, I don't know how. You see, the problem is to really make money on the short side, you've got to be willing to have some serious exposure. When I was running my short book, when I got excited, I'd be 80, 90% short, and things started to work. I'd press it and take it 120, 130, 140. Briefly, if it started to work, I'd step on the gas, because in short selling, it's about your tactics. When do you press? When do you take them off? And all that kind of thing. And geez, given what's going on, I can't imagine a scenario where I'd be comfortable being 40% short, much less 140.
Yeah. Well, so then in the case of the average investor then, who's maybe got some kind of mixture of stocks and bonds, probably no gold or very little, how do you, how would you suggest they kind of look at this environment?
Well, I mean, I think anybody that doesn't have a decent allocation to gold and or silver doesn't understand the situation. And of course, what's decent? I mean, everyone's got to decide what's right for them. But I mean, if you're going to own bonds at handfuls of basis points, you have to have some gold to protect yourself, or you've got to have some sort of protection against the recognition that these policies lead to trouble. So, I mean, I can't tell people what they should do. Historically, it used to be considered normal to have a 5 or 10% allocation to gold. That was considered normal. Now that'd be, that'd be a huge. I myself have, a great deal more than that, but I'm comfortable with that. And it's, these are things that people have to decide for themselves. And the only way you can start to see how you feel about it, you've got to allocate a little to the sector, see how you feel with it. Whether you buy one of the gold ETFs or a gold mining stock, or better yet, buy physical. And then you see how you feel and how does it make you feel, and how do you look at your stocks and bonds knowing you have that? And that's the only way you can really get your head around what you need to do. Is you've got to take a little action. I'll give you a different example. There's been millions. I mean, there's been lots of moments in time where, like, I was short a bunch and I was wrong. I pressed them. And the only way you can figure out where you need to get is you got to start taking them off, right? I got to start getting smaller. Or I have rarely been asleep at the switch when the market's buckled and I felt like I had to get bigger. But again, same thing. You got to add your exposure and see how it makes you feel. So I think anybody that was a friend of mine who I cared about and I sat down to talk to, I don't like to tell them what to do, but I'd say, listen, you have to think about having some gold or gold mining stocks to protect yourself from what's going on. And I would explain why. So that's what I would say to any of your listeners. I don't want to sound radical, but it's almost foolhardy, given what they're doing and what they're going to do, to not have some exposure to precious metals. And you could look at it like, okay, I'll have a 5% allocation and I hope that it doesn't work, because that'll mean the 95% works. I look at it differently. I'm going to have a much bigger exposure because I think it's going to work, but it all depends on your perspective. But to not have any, or to not think about having any, I think is dangerous.
Yeah, it's like not, I'm not going to buy homeowners insurance or what have you. I mean, I'll be more blunt. I think if you have no gold in your portfolio right now, you're crazy.
Well, it's your podcast. You can say that.
Yeah, that's right. Yeah. Well, Bill, thank you so much for taking the time to do this. I really am grateful to you for spending so much time, just going through and sharing your views with all this stuff. It's super valuable. Where can people kind of keep up with you and your ideas?
Well, I've in the last group of years, I've taken to, tweeting now and again. And so I'm on Twitter at FleckCap. But if people wanted to read I write a column every day and I answer questions, and that's at FleckensteinCapital.com. It is a pay site because I don't want trolls, but I priced it cheaply. It's $120 a year if anyone cares. And if they want to learn more, they can go there.
Well, I think I've been reading you for 20 years now, and I highly recommend it. I can't believe it's been so long that I've been reading your stuff. So clearly you've infected my whole process.
I can't believe that I've been writing the column for like almost 23 and a half years now. I can't believe it's been that long. You were there.
Well, it's been a great service to me, and I know it's been a great service to tons of other investors out there. So thank you so much for doing that. And thanks again for taking the time to do this. Hopefully we can do it again. We won't wait 3 years.
Yeah, and we can do it. We can do it together. We can break all the rules and sit across the table from each other.
There you go. It's a deal. I'll bring the wine again.
Okay.
And that does it for another episode of Super Investors and the Art of Worldly Wisdom. As always, you can find notes and links related to this episode at thefelderreport.com. Thank you for listening, and until next time, buy low, sell high.
Man looks in the abyss. There's nothing staring back at him. At that moment, a man finds his character. And that is what keeps him out of the abyss.